My name is Arthur Mrozowski, and I'm managing partner of Silicon Hill Ventures, a small boutique shop here in San Francisco. And I've been dealing with, for 35 years, with different types of startups, and some of them in fintech. Back in about year 2000, before the dot-com crash, we did the first MasterCard enabled gift card. And then essentially recently we've invested, and I'm part of the company that makes the ring as a form of a payment, just a proximity payment. So that's my kind of a claim to fame as far as myself personally, but also I'm overseeing my kids that are kind of more of a fintech kings in a playground, because they, one of them is approaching the unicorn level in the fintech, and then his brother is also doing very. But enough about me. I think that the subject of the fintech, it's more be more reliant on the Jean and Julia that happen to be today remotely. Jean is coming to us via Zoom from Los Angeles, and Julia is coming from New York. And I will start with the lady, and I would let Julia introduce herself and say a few words about what the AlphaMille is all about, and then we'll go to Jean.
Hi, Arthur. Hi, Jean. Hi, everybody. Can you hear me well? Yeah.
Yeah.
Okay.
It's all good.
Yeah. Okay. Great. So I wanted to give a shout out to Sophie and Hannah from who are from the Baltics, because I was born and raised in Latvia. So, and spent my first 18 years in Latvia, and then came to New York. So I've never seen so many Scandinavians in one place all at the same time as speakers. So this is awesome. I am a managing partner at AlphaMille. It's a technology advisory and consulting shop, and we build technology for startups, for private equity funds / venture funds, family offices, hedge funds, anyone on buy side. And my entire experience is in fintech. And I started out in 1997 on Y2K projects. So it's been quite a while. It's great to be here.
Great. Jean?
MediaShares is a company that project manages capital raises online. If a company is looking for capital, very often they don't have a clue about where to go or what to do. Most of our offerings clients that we work with, their offerings are online and crowdfunded offerings, whether it's Reg D, Reg CF, or Reg A, and we walk them through the entire process, starting with their corporate governance, all the way through onboarding to a platform, helping them select a platform, and even after a successful raise, introducing them to brokers that can do an IPO. We introduce them to lawyers, accountants, auditors. And so basically it's a one-stop shop for helping a company with a capital raise. Thank you. And very grateful to be here, by the way. We love Marty and really appreciate the opportunity to speak at this very prestigious conference.
Second.
Great. Well, thanks so much, Jean. I'm going to start with the question to Julia. Julia is something that is kind of closer to my heart, because essentially for all of the transactions right now that the fintech is doing, you need some kind of a form of unique authentication. It used to be 4 pins on your debit card, and of course that doesn't suffice. The data has been all over the dark internet, and so we need to come up with some kind of a methodology that will enable one to kind of secure most of the transaction, both on the retail and then even let's say on the enterprise levels. So I just wanted to, and that's one of the problems that hasn't been quite solved yet. And I just wanted to see, since you're so close to the subject of what it is that it's, what it's coming, and what kind of technologies you can share with us that are of interest.
Great question. Thank you so much for that. There is a lot that we talk about on the topic of blockchain and DeFi and the potential of technology, but I want to bring it back just for a second to the basics. And the basics is that you need good infrastructure for whatever you're doing. In early 2000s, Fintech was in the forefront of tech. I don't know, going back to those days, right? We were doing program trading. I was at JP Morgan and worked on program trading projects, algorithmic trading projects. And this was way before Amazon, Netflix, Uber, you name it, showed up. And now if you go through your day and you order something on Amazon and you're watching a movie, and you're getting an Uber, there are machine learning algorithms behind all of that, but there's less of that in a lot of fintech that we see because we're still struggling at solving, essentially very, very basic problems of getting out of Excel. And so obviously there's a ton of money going into infrastructure, fintech projects. JP Morgan just invested $20 million into a DeFi company, and we see this across the board. If you are trying to tokenize something, it's pretty easy to raise these days, right? Because we want to have fractional alternatives ownership. And I'll talk a little bit more about that. I just don't want to get into the, right into tokenizations yet.
Got it. Well, Gene, if you think that this is coming in the terms of the tokenization, but tokenization has to still do with some kind of a physical, authentication of some sort, right? So, what do you think, Gene, is the like a new tech that will enable one to authenticate? I mean, we have all the minus the implanting ourselves a chip inside of under our skin. What it's out there that makes the transaction safe?
Well, first of all, let's back up for a second. Crypto was invented because everyone wants the freedom to be able to do whatever they want and to do it anonymously, and that's how crypto got started. Bitcoin was this distributed system was actually created to prevent fraud. It obviously doesn't work all the time, but it was actually invented so that people could do these electronic transfers and create the wealth and everything by being able to distribute it across a wide area. And that's how it got started. Everybody wants the freedom of no regulation. I want to do whatever I want to do. I want to put my money wherever I want to put it, and I want to send it wherever I want to send it. And they love the idea of crypto, Bitcoin to begin with. Now that they've got that and that it's not as secure as it was really designed to be, how do you transfer it? How do you keep it? We all know the story of the guy that had $20 million worth of Bitcoin on a hard drive, and he says, I've looked everywhere for it. And so what do? You can't keep it on a hard drive without possibly losing it. You can't keep it on an exchange without possibly losing it. I mean, that's been proven. So what do? It's a very difficult problem. We talked yesterday, Arthur, about iris identity authentication. How do I prove that I'm me? Whether it's my fingerprint, my eye, my palm. There's even an application now that a door, there's something at the door that sees you walking towards it, and it can identify your gait, how you move. It can tell that's you. So, I mentioned that I had a client that had a fingerprint crypto wallet that read pulse and blood flow. We talked about how the iris requires a rather large device to read the iris and compute it accurately. So it's probably the biggest problem in fintech is identity authentication because of fraud. People want to know that I'm transferring something, it's not going to be lost. How do I get my funds from one place to another? I personally like the fact, working with the FDIC bank, that I can get my money back if it is lost. So I'm not a big crypto fan for that reason. But it's the biggest thing in the world right now. What is identity? What can you do with identity authentication? And my feeling is the iris is the safest, but there are some devices now that read fingerprints pretty accurately.
Sounds good. So there comes some form of a biology aspect to the authentication. And,
yeah, it has to be something from your body.
Triple safe, per se.
Yeah, it has to be
And
something
then
from your body.
Gene, going back to you've been doing a lot of work in the media industry, right? And I don't want to touch the subjects of NFTs and crypto too much, because the next funnel is dedicated solely to that subject. So I just wanted to kind of like touch it, but not really go too deep into it. But one of the projects that my understanding is that your MO is to fund projects using the crowdfunding platforms, right? And so my question to you is this: currently you're using web-enabled number of different platforms to fund your projects, but that's all web-based, and it's kind of like very traditional. It's already 10-year-old technology. Anything new that you're trying to like get the projects for your media, to get the money for your media projects?
Well, the biggest thing now is the new law that allows an issuer, someone raising capital, to be able to do it on their own website. And it's still filled with regulations, which is what every person trying to raise capital wants to do it without the regulations, because they're expensive. If you want to do a Regulation A offering, you're going to spend $200,000 before you can even sell stock. And so that's what everyone's trying to get around, and that's how crypto got started again. But what's going to happen now is people are doing it on their own website. There are firms out there that will, because they are a broker, they are the back end of the issue of the offering on your website, and they assure compliance with the SEC rules. I don't think you're going to ever see offerings without extensive regulations. As much as everybody would like to get rid of them, there are people out there that take advantage of people and want to get money. I often tell my clients that people in the financial services, they went in this business to make money. They didn't go into teaching or nursing or whatever. And that brings to the industry people that are money focused, many of whom don't have the ethics that are really needed to handle somebody's money, and there are abuses. So there'll always be these very strict SEC regulations to help monitor those people and prevent them from taking your money. So you're going to see, I think, more on websites where a company takes its, and because when you go on a platform, you've got all those other offerings on there. I've mentioned this before. It's like a good going to dance. There's a lot of other good-looking girls there. So when you post your offering on a platform, there are a lot of other offerings on the platform, many of which are better than yours. So you drive traffic to that platform to get funding, and people look at the other offerings, and some of them are better than yours. So the idea of being able to place your offering on your own website and drive traffic to it, I think, is going to be the biggest thing.
What do you think, Julia? Because you have the same kind of like, what do you think that, is there even a replacement right now for doing the crowdfunding for any of those companies that is web-based? Do you see any forthcoming tools or enablers that have ability ability to get the something that it's really new, right?
Yeah.
Because those platforms, the Indiegogos and the Republic and so on, they've been out there for literally, decades now.
Yeah.
And new approaches that you've seen there in New York, the center of gravity of all of the fintech.
Yeah, so this is such an amazing topic, and there's so much happening there. That I'll make a few remarks and give you a couple of facts. So the first one is that 30% of institutional investors direct their investment towards alternatives, right? So that's your venture, private equity, real estate, infrastructure, etc. For households, it's only 2%. So obviously there is a desire, the reason that we saw so much success with crowdfunding is because there is a desire to invest in these asset classes. That desire is not going away. It's always going to be there. And there are, however, there are now more opportunities to present your product out there, and even through crowdfunding, etc. But it's got to be the right product. It's got to be something that people can understand easily, right? If they see your ring, the one that you're wearing right now, it's kind of a cool thing, and I don't have to be a CTO to understand it. You know what I mean? Like it's cool. It's something that I can use, and they love it. Miso Robotics is a company that creates these arms. It's just an arm, and they're in McDonald's. There's just a standalone arm flipping burgers. They have 10,000 people who crowdfund, who are investors, 10,000 investors, because it's something that, oh my God, it's visual. You look at it, it's super cool. Every McDonald's is going to need it. And these are the hands that do a lot of stuff, right? Like anybody can use a robotic hand. So, I think that what's going to happen is, as Gene was saying, with advice of companies like his, or by trial and error, these venture companies the startups are going to figure out what is the right fit for me. Do I want to be listed with everybody else? Do I want to have, my own listing on my own website? Or what do I do? How do I monetize, maybe my own investment? Do my own equity, right? The pre-IPO equity. So there's a lot happening in that entire space.
Yeah, I just don't see like the private equity jumping into, unproven startups nowadays, especially that the current flow of the capital seem to be kind of drying up for all of those startup companies that wanted to be developing new products in let's say insurtech or fintech and whatever. They're just going to grab $500 million and then just come up with a business plan, right? I mean, they are required right now to come up with some kind of a tangible idea that can prove, even in a smaller scale, that it actually works before they can tap into the venture or PE, like the private equity firms. Although I don't think that the private equity is going to be putting even a dime until the whole mechanics are physically working, and then a proof of generating revenue is there.
Arthur, let me address something that relates to that, and that is that the platforms now are becoming much more selective in accepting your offering. They have most of the platforms like Start Engine and WeFunder and Republic. I had a potential client that Republic wouldn't accept. And I know that Dealmaker, which is the firm, one of the firms that does your offerings on your own page, they're very selective before they'll take someone. And so if you want to place your offering now, you go through a committee, an investment committee on these platforms. So the idea of just posting something and getting a lot of money and not having a valid business. They want to know your revenues. They want to know you. They want to look at your financials. They want to, they want to see some traction, just like a venture capitalist. So anyone that's raising money now, there are exceptions, of course, but anyone that's raising money now really has to have a valid business. You can't just go online and say, I've got this great idea and I want to get your money. No, those days are gone. It might have been that way when it first started, when the platforms were formed, because they wanted to get some traffic on there, but now they're very selective. And even the marketing companies, some of the most successful marketing companies, if you want to get with them, you have to have a good deal. They won't take your money. You can spend $10,000, $20,000 a month marketing your offering that's online, and the big, really good companies won't accept you unless they think you really have a valid business.
Yeah, it's interesting. I promise not to touch too much on the subject of the crypto, but recently we have those NFTs that nobody really understands on how to explain what the NFT is. I mean, I've been on the panels and I've read the book, and I'm just still kind of confused about the whole subject, right? But what's interesting now that the people that are advertising, such as like Kardashians, were just slapped with some kind of a number by the SEC for selling the NFTs, right? And they were also like a mechanism for let's say for the companies to get funded, right? You were releasing some kind of NFT, and then boom, you were collecting a bunch of monies, and then the value of those cryptocurrencies were kind of unknown, because like even if I can understand, I bet like 80% of people my age don't understand what the heck is going on. So
let me tell you something funny. Or my wife said, so wait a minute, these things that you're investing in, they're imaginary? Can we invest with imaginary money?
that's a cool, good way of putting it.
I think that there's when we speak to clients that want to create NFTs, right, or do anything along those lines, they always have a good reason. They know that it's related to some sort of a celebrity and there's going to be resale value, right, in any shape or form. But it's almost like when there is, the beauty of our system, of the capitalist economic system, is that when regulation is strangling the life out of something, so that something is gonna find its way, okay, hell or high water, it's gonna go somewhere else. And what you're seeing is, it's like, oh, okay, you're printing money, you're inflating, here I have crypto and I can move across borders, right? Or there's the public market is so heavily regulated. So now it's gonna, and we're not making money on bonds anymore. So now people are gonna go for that, PE / alternatives ownership. And if you cannot buy an entire building on Park Avenue, you can tokenize that and own, a little bit of that building. And that could be a better investment than Microsoft, right? Or JP Morgan. And so something that I read recently that really surprised me was Jenny Johnson, the CEO of Franklin Resources, 1.4 trillion money management giant. She spoke to Bloomberg this August, and she basically said that, look, half of the public companies that were there in 2000 are no longer here. And we're going to have to figure out how to democratize private assets, analogous to what her grandfather was offering in terms of mutual funds to retail investors, right? So essentially, what's happening is, yes, we were able to create this mutual funds and ETFs that followed, right? And people started like massively investing in markets. And I think that we're just getting there in terms of figuring out how to do that with private assets. And it's going to come in such a huge variety of way. And then there's going to be the whack-a-mole of what's going to get regulated first, right? And get regulated out of existence. But everybody is going to try to raise money from their website, another website, through a private equity mutual fund that sooner or later is going to show up, through tokenization. I mean, people come to us and they're like, we are building vacation homes and we want to tokenize that. You know, so you get the NFT, right? So it's like tokenize anything that you have. Vested was set up to basically you know, enable some kind of secondary markets for people holding shares, right? So before it was the CEOs coming to JP Morgan's and trying to monetize their restricted stock. Now it's pretty much everybody. So there's
I got it. I mean, that's easy to understand. Like, let's say, I mean, I did have the NFT, for example, connected to the tangible assets, like a, you know, like a building, right? Or perhaps like the piece of artwork that's like 1% of that artwork is tokenized and sold as NFT. But my question is, like, how do you correlate that value that you have the NFT into the fiat and actually taxable or regulated asset, right? Because all of a sudden you own something of the value, and then how is the current regulatory system looking at those things, right? Because even it, like what is the NFT connected to? Is it connected to like virtual currency that doesn't have any value? Is it connected to the fiat, connected to the currency, or is it connected directly into the value that pertains only to the asset?
I think it's a baseball card that has a royalty share built into it. So if you buy a baseball card, what is the value of that, right? The value is that you can sell it to somebody. And believe me, I keep buying them for my nephew. So there's a real freaking value to them. But what's happening with NFTs is, as they're being resold on the secondary market, because it's done via blockchain, we build in a little bit of equity. So you get paid anytime this continue being sold. In my humble opinion, it's a lab. It's something that we're playing with in preparation for metaverse. And for at some point, you know, this is like, you know, people playing with this and figuring out how do you combine that celebrity or whatever, you know, art or whatever is happening, while we are also playing with the business models. Do you know what I mean? Of all of that. And at some point it's going to meet with some kind of development. That's how I see it. Gene, what do you think?
Here's my question, okay, which is, I think, a pretty important one. If I sell you an NFT and I tell you it's never going to be worth any more than it's worth now, you just got to buy that and understand that it's only going to be worth what it's worth now. It's never going to appreciate in value in any way, shape, or form. Would you buy one? No. Everybody buys an NFT anticipating that it's going to be increased in value. That, as part of the Howey test, makes it a security. So how are you selling it? And you're telling people I'm buying this and so-and-so is going to be, you know, it's a baseball card. It's going to be worth in a few years even more than it is now. That's a security that seems to me, I mean, that's the Howey test, right?
You have to keep the SEC away from the baseball cards.
So everybody that's doing an NFT right now, they're doing it to skirt the regulations. Because if you have a stock, it's so much easier to sell a stock on an exchange. It's just a lot of trouble. And when I say easier, I mean it's easier to liquidate. And you have a value there. It says how much it's worth and what's it worth tomorrow, or what's it going to be worth. You can look at the financials and see they're growing. It's going to be worth some more, and so it's all highly regulated.
You see, I see an infrastructure business, you know, behind this play, because in one of the cases, one of the really prominent NFT exchanges, right, basically said, "Oh, we're just and this was kind of in a private conversation and strategy and technology conversation, right? And they basically said, you know what, it's great, we're going to put up like a couple of pictures out there, right, and attract attention, but in reality we're going to be the AWS for the digital assets of you know, movie, you know, your LA, you know, Harry Potter, like, you know, they're digital assets produced by the movie industry, etc. Right? So they don't want to put them necessarily on AWS. That's not blockchain. But if you are producing a lot of artifacts like that, right, where images are, you know, part of movies, etc., then it becomes a very interesting business model for them to build out that AWS type of blockchain service. And I think that from that perspective, with people who are creating all of these, you know, open exchanges, right, or NFT exchanges, somebody there is sitting around and thinking about, how am I going to monetize this and what am I going to do? Because it's easier to go to Warner Brothers and say, look at these NFTs, we can store your assets there for you too. So that's just my...
And while they're thinking about that, Julia, the SEC is thinking about, how are we going to regulate this? I promise you.
That's right.
It's just a matter, it's a matter of time, because the farther this aspect of fintech goes, the more you're going to draw the attention of the SEC, and the more the SEC is going to try and regulate it.
Well, it's like neobanks, right? Or a lot of startups that are, you know, they're doing loans, etc. And essentially, the regulators are now working through the banks, right? And they're regulating what these startups are doing, right? And I heard this summer that anyway, it's you know, there's a saying that they're peacock's feathers, but you know, beyond, like behind the or below the peacock feathers, there's a chicken, you know what?
There's a chicken.
There's something, you know, there's just something that, and that is the truth. Anytime you talk about regulations, you know someone's going to have to fulfill all of those requirements. I
like the regulations. I like the fact that my bank will reimburse me if somebody stole my rent check out of a post office box, and my landlord said my rent has not been paid. And I said, what are you talking about? I mailed you a check. And he said, well, and some guy, and if anybody knows Eric Quintero, please tell me where I can find him, because he wiped out my landlord's name and wrote Eric Quintero on there and cashed my check, but Citibank gave me the money back. Try that with crypto. You know, call up the exchange and say, somebody ripped off all my money, and see if they pay you back, or see if the government pays you back. You will lose. You will lose your money.
There's a question from the audience.
You don't have to give straight numbers, but proportionally, how much of your total net worth or assets?
Yeah. I let you actually talk to the microphone. How's that? Here. We have high tech.
Thanks. So I just have one question. You don't have to get into straight numbers, but proportionally, out of your total net worth, how much of your investments are in crypto?
Is that for me?
Yes.
I have $20 worth of Bitcoin.
Okay, so you're very knowledgeable in the space, but you don't have a lot of skin in the game, I would say.
Well, I learned.
Would say that we have a next panel that actually is more of the crypto.
Let me answer. Let me just answer that one question. I had a client with a crypto wallet. I went to every conference in the world: Zurich, Warsaw, London, San Francisco, and I sat there and I watched every conference, and I talked to everybody in the crypto world, and I became quite knowledgeable on it. So and I have friends that lost millions of dollars in crypto. So I wouldn't say that I'm an expert on it, but I know quite a bit about it. And I prefer the regulated world of the New York Stock Exchange, registering your offering, working with a bank that's insured. Anyway, that's my 2 cents.